My name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Invest Associates International Limited. And here is your weekly technical analysis of New York and London sugar. I'll start with ICE raw sugar. The recent V bottom formed over March and April with its low based, interestingly, on lesser 61.8% Fibonacci line of the October 2016 to April 2020 move at 1474, no doubt abetted by the congestion between 1410 and 1560 from October to December 2020. Well, it has seemingly run its course. Friday has seen the market peak and be held down by the very recent 50% Fibonacci line of the late February to late March move at 1681. In addition to the support from the lesser Fibonacci level at 1467, I suspect the nearness of the rising long moving average, currently at 1448, had something to do with the move higher. It is odd, as all the other moving averages had relatively little impact on the way down and on the way back up. One can say that the very recent 50% Fibonacci line is capping the current market. As to whether the flatlining short-medium moving average, currently 1617, or even the ever so gently rising medium moving average, currently 1573, can support the market, well, I'm not so certain. Interestingly, the February 2020 high at 1591 might very well act as support, as it did back in early March. Meanwhile, topside, well, we still have the large and small gaps from February, 1677 to 1680, that's the small gap, and late February, 1670 to 1732. I suspect the large gap is looking a bit onerous in all this. Finally, the uptrend of the V bottom is still there as support, currently at 1579, though it is only a two-pointer. ICE Europe white sugar. Compared to the New York contract, this one is still different. Primarily the April to July 2020 bullish shift pitchfork has worked. It has been broken over the last 2.5 weeks, but has seemingly repaired itself enough to function and still seem important. The market's fall back then was halted seemingly by the lesser 38.2% Fibonacci level, the April 2020 to February 2021 move at 419.30, after the market had broken down through the lower time, currently 431.70, with a bullish shift pitchfork. However, I suspect it may have been the proximity of the rising long moving average, currently 408 even, that may have had a perhaps larger if obscure impact. In this, I'd suggest looking at Monday last week's dip and rapid recovery as possible evidence. This rapid recovery last week was quite something, up through the lower time, the medium moving average, currently 439.90, then gapping higher and pushing up through both the recent 50% Fibonacci line at 452.30 and the short medium moving average, currently 454.90. The week, unsurprisingly, ended as a weekly key reversal up, and the market has done a lot of the heavy lifting towards making it a monthly key reversal up as well, though not quite managing it as yet. The high last Friday was a little surprising. It seems we have developed some resistance that was already from there back from early and mid-March into something a little stronger. So what now? Well, let's see if this bullish shift pitchfork still functions in giving the bullish angle of attack, and what the outcome of the weekly key reversal up will be. Just don't forget the gap on the way up between 443.90 and 444.90. White premium spread. The recent move lower started 4 weeks ago with a combined outside week and bearish engulfing pattern. The following week, we saw a move down through the recent 50% Fibonacci line at 100.50 and a test of the long moving average, currently 93.75. The week after saw a dramatic fall, down to the 50% Fibonacci line of the July 2019 to May 2020 move at 80.25. However, last week was the most interesting, as prices first dropped down through the lower time, currently 78 3/4, of the big July 2019 to November 2020 bullish shift pitchfork, then down to the old neckline of the February to September 2020 head and shoulders pattern, before staging a rapid rise back up. In that 1 week, prices formed a weekly key reversal up and a bullish double, and it also seems that the move down below the lower time may only be just a breach rather than a full break of the bullish shift pitchfork. This week we are back within the area bordered by the lower time below and the next significant overhead resistance, the downtrend from the May 2020 to date action, currently at 111 1/4. To be honest, neither is that great a force. The lower time has been breached and the downtrend is just a 2-pointer. This means that they both can be tested and may buckle, though the lower time is the seemingly stronger one right now given recent action. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.